Welcome to the Deep Dive. The last 24 hours in the crypto market have been, well, undeniably dramatic.
Definitely.
We saw Bitcoin hit a new peak, soaring past $124,000, only to then drop pretty significantly, shedding, $6,000 in just about 2 hours?
Yeah, it was fast.
Yet even after that rapid descent, it's still holding strong around $118,000, which is, historically speaking, still very high territory.
Absolutely. It's important to keep that perspective.
So what truly triggered these intense shifts? Today, we're diving into a compelling analysis that unpacks the multiple factors at play.
Sounds good.
Our mission is to extract the most important insights from this material, helping you understand the real forces driving crypto volatility, and maybe more importantly, the underlying trends that are, easy to miss amidst all the noise. Okay, let's start unpacking this.
It was indeed a swift downturn, yeah. And for anyone watching the charts, a $6,000 drop in 2 hours can certainly feel alarming. But like you highlighted, even at $118,000, we're still looking at a very strong position for Bitcoin historically.
Right.
Initially, a few theories immediately started circulating. Some pointed to fresh producer inflation data, while others highlighted recent statements from the US Treasury Secretary. But as is often the case in these markets, the full picture is far more complex than just the immediate headlines suggest.
That's a great point. And while inflation data often gets maybe misinterpreted, let's make sure we unpack the Producer Price Index, or PPI, clearly. Can you explain what PPI actually measures and how it differs from, say, the CPI, which we typically hear more about?
Certainly. So PPI measures wholesale inflation, essentially, the average change over time in the prices that producers receive for the goods and services they produce.
Okay, so producer costs.
Exactly. Think of it as the price tag for manufacturers and producers before it gets to the end consumer. It's distinct from the Consumer Price Index, or CPI, which tracks what you and I pay, at the store.
Got it.
So while a rise in PPI can eventually trickle down to consumer prices, it's not an immediate thing or even a direct one-to-one correlation.
And the latest PPI figures themselves. How significant were these numbers really, and what aspects of the report caused the most apprehension among investors?
Well, the numbers did come in notably higher than forecasts. The core PPI was reported at 3.7%, against a forecast of 2.9%.
Oh, wow.
And the overall PPI came in at 3.3% compared to a 2.5% forecast. What truly caught attention, I think, was that this represents the highest monthly PPI increase since March 2022.
Right. That was a period of really surging inflation.
Exactly. So that naturally generated some apprehension, particularly regarding interest rate expectations.
Right, because just yesterday, the market had almost, a 100% confidence level for a significant 0.5% Fed rate cut in September.
Pretty much locked in, or so it seemed.
How dramatically did those expectations shift after this PPI announcement?
The shift was quite stark. After the PPI data was released, the expectation for that 0.5% cut largely evaporated.
Just like that.
Yeah. Now, the overwhelming market expectation has returned to just a 0.25% cut, with about a 90.6% probability, or even possibly no change at all at 9.4%.
Okay.
This essentially reset market expectations back to where they were just a few days prior, really, before this latest wave of optimism took hold.
But here's the crucial detail, isn't it? If the PPI data was so significant, why did traditional markets like the Dow Jones, S&P 500, and NASDAQ show minimal, almost no reaction?
Right.
Oil and gold were similarly unaffected. You'd typically expect some pretty significant movement, especially in tech stocks, if there were widespread fear about inflation.
Precisely. If there were genuine widespread panic stemming from the PPI, the tech-heavy NASDAQ would usually bear the brunt of it, right? Since tech stocks are often seen as more sensitive to inflation and rate hikes. However, the Dow Jones closed down, a mere 0.02%. The S&P 500 was actually up a tiny 0.03%, and NASDAQ futures showed a slight increase.
So basically flat.
Yeah, basically flat. This indicates that traditional markets weren't really spooked by this data. So this raises an important question.
Yeah.
If traditional markets weren't panicked by the PPI, why did crypto react with such a sharp downturn?
That's a critical distinction to make. So if traditional markets weren't reacting to PPI, it fundamentally shifts our focus to other potential drivers, specifically within crypto. Let's turn to the US Treasury Secretary Scott Bessent and his recent comments on Bitcoin reserves. What was his initial statement that seemed to cause such a stir?
Okay, so his initial statement on Fox Business was that the U.S. holds an estimated $15 to $20 billion in confiscated Bitcoin reserves.
Right, from seizures.
Exactly. But currently had no plans to purchase more. He also explicitly rejected the idea of revaluing U.S. gold reserves, which are still booked at that old 1973 price of $42 an ounce to acquire Bitcoin.
Which Senator Limas had proposed, right?
That's the one. Yeah, she had notably proposed that concept.
And this seemingly straightforward statement led to, well, palpable disappointment in the crypto market. Why was that? Were people truly expecting the government to start actively accumulating Bitcoin?
It seems many in the crypto community had indeed fostered those hopes, yeah. Perhaps interpreting President Trump's executive order on strategic Bitcoin reserves as, a precursor to direct purchases.
Okay.
So Bassin's initial comments seemed to, well, pour cold water on that expectation, leading to noticeable market disappointment.
But then he issued a swift clarification, almost a reversal, on X, formerly Twitter. What did he say then, and what does this reveal about the official stance on crypto policy? It seems complicated.
Very. On X, Bassin quickly reversed course, affirming that the Treasury will seek budget-neutral options to acquire more Bitcoin.
Budget-neutral, okay.
Which this statement aligned closely with President Trump's stated commitment to establish the U.S. as a crypto superpower. Bassin clarified that while the president can't just directly order new tax money to buy Bitcoin without congressional approval, the search for these budget-neutral methods, like using funds from tariffs or maybe government savings, is actively ongoing. What's fascinating here is just the swiftness of the reversal of a high-profile statement. It really highlights the nuanced and, frankly, often evolving public stance of officials on crypto policy and just how sensitive the market is to their every word.
Definitely shows that sensitivity. So if neither the PPI nor the initial Treasury Secretary's comments were the primary driver of this sudden dip, what then was the real force behind Bitcoin's rapid descent?
The most significant factor by far seems to have been a massive wave of leverage liquidations, what's commonly known as a long squeeze.
Right.
In the past 24 hours, over $1 billion in leveraged crypto positions were liquidated. More strikingly, over $550 million of that happened in under 2 hours.
Over $500 million in just 2 hours. That sheer volume of liquidations is truly striking. And you mentioned long positions specifically. For our listeners, what does that mean in this context?
Right. So the vast majority of these liquidations, about $875 million worth, were long positions. This means traders were betting that Bitcoin's price would go up, often using borrowed money leverage to amplify their potential gains. When the price started to drop even slightly, these highly leveraged positions quickly reached their liquidation point, which forced them to be automatically sold off by the exchanges. This, in turn, pushed the price even lower, triggering more liquidations and a cascading long squeeze effect. It's a common, though often painful phenomenon in the crypto market, where excessive optimism and over-leveraged long positions frequently set the stage for these kinds of rapid pullbacks.
It sounds like a painful domino effect, yeah. But you also hinted at another, perhaps more ironic factor that might have played a role. Are we talking about the infamous Cramer effect?
Indeed. I mean, it's become almost a meme in the crypto community, but one with a surprisingly consistent track record, you might say.
Okay.
Just the day before this significant drop, Jim Cramer was exceptionally bullish on Bitcoin. He even declared that the rally can't be stopped today, and on his show went so far as to call the current market a buyer's paradise.
A buyer's paradise. Right before a $6,000 drop. And this brings us to that phenomenon that many in the crypto world watch with a mix of, I guess, amusement and trepidation. The Cramer effect has become this widely observed inverse indicator. His bullish calls often seem to precede market downturns, and, well, this time it happened again. It's more than just uncanny. It kind of highlights how deeply certain public figures can maybe unwittingly signal peak retail exuberance, which historically often precedes corrections.
It's a fascinating microcosm of market psychology playing out in real time.
Yeah.
Exactly. Whether it's purely coincidental or maybe a psychological factor influencing some traders to actively fade his calls, the pattern is certainly uncanny, and it speaks to a certain contrarian sentiment that has definitely developed around his predictions.
So a combination of over-leveraged long positions getting squeezed and maybe a highly anticipated Cramer effect seems to be the real immediate catalyst here. But looking beyond Bitcoin's dip, how did the altcoins fare, and what does that tell us about the broader market health?
That's where we actually see some encouraging resilience, I think. Bitcoin dominance, which measures Bitcoin's share of the total crypto market cap, is currently around 59.57%,
Okay.
It has remained below 60% and has actually been trending down over the past, say, 1 to 6 months. It dropped from a high of maybe 65, 66% back in June.
So altcoins are holding more ground, relatively.
It suggests exactly that, yeah. Altcoins are holding their ground better than in some previous cycles.
So when Bitcoin dipped by, say, 4.2%, how did major altcoins like Ethereum, XRP, and Solana react? Because in the past, they would often suffer much larger percentage drops during Bitcoin corrections, wouldn't they?
You're absolutely right. Unlike previous periods where altcoins would sometimes experience disproportionately larger losses, today we saw more comparable percentage drops. Ethereum was down about 3.7%, XRP down 5.8%. Solana saw similar declines, while BNB actually had minimal change.
Interesting.
This indicates potentially a healthier overall market and more altcoin resilience. It suggests that capital isn't just fleeing altcoins en masse the moment Bitcoin sneezes.
Right.
And we also saw stable weekly unemployment claims, around 224,000, which is close to estimates. So no major economic shocks coming from that data point either.
That's certainly a more positive sign for the ecosystem as a whole. And shifting to more optimistic news, we've seen some really fascinating developments in institutional adoption that go way beyond mere investment. Let's delve into Sequence Communication from France and their, frankly, ambitious Bitcoin accumulation goal.
Yeah, Sequence Communication has set a pretty monumental goal to accumulate 100,000 Bitcoin by 2030.
Wow, 100,000.
Yeah. They started in July of this year with $384 million and currently hold 3,171 BTC, which already positions them among the top publicly traded companies by Bitcoin holdings.
Okay.
And their strategy?
It's multifaceted. Initially, they'll raise public capital, through stock or bond issuance to acquire more Bitcoin. Then from next year onwards, they plan to accelerate by leveraging their existing Bitcoin holdings as collateral for loans to buy even more Bitcoin.
Using Bitcoin to buy more Bitcoin. Essentially, yes. By 2030, their aim is to optimize their portfolio with Bitcoin-based financial products, progressively reducing their reliance on further stock issuance. It's a really sophisticated long-term play.
That's a bold and intriguing strategy. Shows a deep commitment to Bitcoin as a treasury asset. Now, there's an even more unique story involving TWF, a Bitcoin miner, and Flux, an AI company, with Google stepping in. This truly highlights a fascinating convergence.
It really does. So TWF, a Bitcoin mining company, is leasing out its excess space and, importantly, its computing power to Flux, an AI company.
Okay.
And the deal is huge, $3 billion over 10 years, with an option for an additional 10 years at $8 billion.
That's massive.
It is. And the truly fascinating detail here is Google's involvement. They are guaranteeing $1 billion of these lease payments in exchange for an 8% equity stake in TWF.
So Google is essentially backstopping part of the deal for a stake in the miner.
Precisely. This isn't just a deal, it's a powerful illustration of the convergence of AI and crypto infrastructure. It shows how the immense computational power built for mining can also be a foundational backbone for AI development, drawing in traditional tech giants like Google.
That's really something. And we're even seeing traditional financial behemoths like Citigroup exploring stablecoins and ETF-backed lending. What's the strategic significance of a bank of Citi's stature making these kinds of moves?
Well, when a global institution like Citigroup, with its deep roots in traditional finance, actively considers issuing stablecoins and offering services related to crypto ETF-backed lending, it signals a profound shift.
It's not just fringe anymore.
Exactly. It's not just about speculation anymore. It's about integrating crypto assets and blockchain technology into the very fabric of global financial services. These moves collectively underscore significant institutional confidence and a strategic long-term integration of Bitcoin and crypto into the broader global financial and technological landscape, despite, any short-term volatility.
So what does this all mean then? Despite the immediate market fluctuations, these institutional moves paint a very different picture of long-term strategic growth. And speaking of institutional interest, when we zoom in on Ethereum, we see an even more pronounced surge of institutional confidence, particularly in its ETFs, right? How did its ETF flows compare to Bitcoin's yesterday and today?
That's a great point of contrast. While Bitcoin ETF saw a negative daily flow today of $292 million after closing yesterday, with a positive $86 million Ethereum ETFs have been remarkably strong.
How strong?
Yesterday, they recorded a positive inflow of $729 million.
$700 million, wow.
Yeah, and today they added another $119.9 million on top of that.
That's a stark contrast indeed. And how did Ethereum's price correction today compare to Bitcoin's? Was it less severe?
It was, yeah. Ethereum's price correction today was less severe than Bitcoin's, down about 3.7%, and it continues to hold above that $4,500 level. This, combined with those robust ETF inflows, suggests pretty strong underlying demand and maybe a more stable base for Ethereum right now.
Okay, this brings us to a really compelling vision from Coinbase about the future of AI and crypto. They're predicting autonomous AI agents controlling programs and making self-payments without human intervention. How would that even work, like, technically?
Yeah, Coinbase's developers envision this future where AI agents can autonomously control programs and execute self-payments using stablecoins.
Oh.
This would be enabled by innovations like EIP 402, which implements a kind of payment-required mechanism for certain operations, and EIP 339, which basically allows AI to securely sign transactions.
So the AI can own and spend money.
In a sense, yes. Imagine a self-driving car automatically paying tolls as it drives, or an AI creating content on demand and autonomously paying for source material or compute time.
Right.
Or an AI managing complex tasks and paying for long-term data storage services as needed, all without direct human oversight for each transaction.
Those are vivid examples. Why is crypto uniquely suited for this kind of future as opposed to, say, traditional banking systems? What makes it the ideal fit for this automated economy?
Well, traditional banking systems are just, frankly, ill-suited for this type of seamless, automated, microtransactional environment.
That's so.
Banks are generally closed systems, right?
Right.
They require intermediaries, prior authorization, often manual steps for almost any transaction. Like, a self-driving car can't just deduct a toll directly from a traditional bank account without a whole lot of prior setup and likely human intervention somewhere in the loop. Crypto, on the other hand, with its direct peer-to-peer nature, its open and programmable networks, and its self-executing capabilities via smart contracts, is uniquely positioned to enable this future.
Makes sense.
It allows for instant, permissionless, and potentially tiny micropayments at scale, which aligns perfectly with the needs of autonomous AI agents. Now, of course, it's worth acknowledging that Coinbase has a vested interest here, as their base network is built on Ethereum, so they directly benefit from its ecosystem growth, transaction fees, staking, all that.
Right. That's fair context.
But that doesn't necessarily diminish the validity of the vision itself.
No, it doesn't diminish the compelling nature of the vision. If we connect this to the bigger picture, this vision isn't just about payments. It really feels like it's about a fundamental shift in how automated systems will interact with the economy, hinting at a future where AI and crypto aren't just related, but like inextricably linked.
Absolutely. It paints a picture of a more autonomous, efficient, and deeply interconnected digital economy, really driven by these technologies working together.
So what might appear on the surface to be a simple market downturn, maybe driven by momentary panic or an unfortunate bullish call, is often actually a complex interplay of various factors. Some are short-term and emotional, like those massive leverage liquidations we talked about, or the Cramer effect, maybe signaling peak exuberance.
Right, the noise.
Exactly. But others represent much deeper, longer-term trends, like the accelerating institutional adoption we just discussed, Sequence, TWF, Citi, and that fascinating technological convergence of AI and crypto infrastructure.
Yeah, exactly. The daily volatility can definitely obscure that larger, arguably more significant narrative that's unfolding underneath.
Indeed. So, despite the daily fluctuations, the immediate disappointments or excitements, what does the continuous strategic movement by established companies like Sequence Communications' methodical accumulation, that TWF Flux Google deals groundbreaking convergence, Citigroup's strategic moves into stablecoins, along with these visionary outlooks from industry leaders like Coinbase, what does that tell us about the maybe inevitability of crypto's role in the future economy? Regardless of these minor price corrections, and maybe what part might you, the listener, play in this evolving landscape?